Hey everyone, it's Tuesday again, and so that means it's time to talk about taxes. Again, given that we've just entered September, hard to believe, which historically has brought North Carolina some of its strongest hurricanes, and in light of the hurricanes that we've had in the news recently, I wanted to focus today on what are known as disaster losses. Generally speaking, a disaster loss is exactly what you think it is. It is a tax deduction that you take when your property sustains damage due to a natural disaster. You cannot take a deduction for a loss that's covered by insurance, but for any portion of a loss that's not covered, the deduction is, or I should say it might be, available to you. I say might be though because prior to the Tax Cuts and Jobs Act in 2017, uninsured losses stemming from a natural disaster were deductible almost as simple as that. However, after the Tax Cuts and Jobs Act, Congress implemented a new requirement, and so I wanted to break down everything you'll need to actually write off a disaster-related loss on your tax return. First, and perhaps most importantly, the loss is only deductible if the damage is related to what's called a federally declared disaster. Now, you've probably seen that on the news. They will announce a federal disaster declaration, but now that distinction, that's incredibly important. Not every disaster is going to receive a federal declaration, and unlike tax year 2017 and before, we now need that in order to write off a loss related to a natural disaster. So if you're thinking about this in the context of a hurricane, your inland Raleigh home might sustain some major flood damage, and if you don't have adequate flood insurance, you're going to be stuck footing that bill. At least you can write it off, right? Maybe, maybe not. It all depends on whether or not Raleigh is covered by that federal disaster declaration. So that's a big deal. And if we stop there, the best advice is really to make sure you're covered because adequate insurance is going to be key here and perhaps more critical than it was before. Of course, though, we really can't stop there. In addition to needing a federal disaster declaration, in order to write off a loss related to a natural disaster, you must also itemize your deductions. So given that the standard deduction now has increased to $12,400 for single filers and $24,800 for married filing jointly filers, damages may not even rise to a level high enough to take the deduction. You've got to exceed those amounts in order to reach the threshold to write them off. But let's just say that they do. Even if they do, we've got an additional hurdle here. The damage now must exceed 10% of your adjusted gross income. So to recap, in light of the Tax Cuts and Jobs Act, writing off a loss related to a natural disaster now requires an uninsured loss, like it always has, a federally declared disaster, that you itemize your tax or your deductions on your tax return, and that the loss exceeds 10% of your adjusted gross income. Excuse me. As we're entering the peak of hurricane season, best advice again, make sure you've got adequate coverage on your property, especially if it's coastal property. We aren't insurance agents at NC Planning, but we do know some good ones, and if you want a referral, just let us know. Really, that's all I have for you today. As always, thanks for watching, and we look forward to seeing you next week. Thanks.